Development and Welfare in Global Society. This session will be moderated by Professor Satoshi Nakaide from Waseda University, School of Commerce and Exeter University, UK, and Exco and Board of Director members of this conference, and he received a PhD from Hitotsubashi University in a major in law. Yeah, please.
Thank you very much, and it is the greatest honor for me to make as a moderator here. And actually, this is my first time to come to Jeju Islands. I was much impressed by its beauty, but especially this university is so spacious, very large and beautiful. Facilities is excellent, and students are very kind. But I took so much time to find this place because the place is so large. But many students advised me to go there and so on. So this was my first impression. And thank you very much, Jeju University, for holding such a nice venue for us. And also today, in our session, we welcome a very distinguished presenter and commenters as well. And this is thanks to Professor Honjo Young. I admire his great efforts as well as ability to gather so many great people to this place. And I will introduce the speaker later. But today's topics in our session is very broad, actually. The financial inclusion, development and welfare in global society. And when we are making research, we tend to make the point very narrow and small, but at the same time, we need to have a very wide view. So it's very important. And protection of financial consumers in financial products is very hot issue, but at the same time, we have to think about the financial inclusion, accessibility to finance, micro-insurance and microfinance as well. So the protection of financial consumers is only for the person who could buy financial products. So we have to think about the people who cannot buy financial products, including insurance. And this area is increasingly very important in many countries. And World Bank and United Nations are very interested in this topic as well. And also, we have to think about the social responsible investment as well as green finance. And this is also related to the protection of consumers and also thinking about the global sustainable society. So the financial protection of financial consumers is the key, but at the same time we have to think about many other things. So in our session we are discussing broadly many things, and I hope you will join our discussion later. And at first, we will have two presentations. One is from Yehuda Kahane, Professor of Tel Aviv University, Israel. So you well know, you know him very well. If you click his name in the internet, you will find so many pages. For example, in the Wikipedia, there are pages and pages for his great efforts and achievement. And he owned many awards, international awards. And he is specialized in insurance and risk management, and very well worldwide renowned. And he makes many presentations worldwide. And I admire him that he is doing academic research. In addition, he is very influential in society. And second speaker is Professor Sankarshan Basu. He's the former 8-year president, and he's a professor of Indian Institute of Management, Bangalore, and he obtained a PhD from LSE, and he's working worldwide and makes so many contributions, not only academics but also in society. So after two presentations from distinguished people, we welcome discussions from two professors. One is Rofikoh, Rokhim. She is the head of Management Research Center of University of Indonesia, and she obtained PhD from University of Paris first, and she is responsible for many things in Indonesia. And also, second commentator is Ahcene, Lahasasna, difficult for me to pronounce, but he is the associate professor of the Global University of Islamic Finance, and he's one of the very, very, very good, excellent people, specialists in Islamic finance. So far we have 5 different jurisdictions, nations. So the presentation will be very global or international, and you will enjoy the presentation, and please join our discussion later. So let's start our presentation. So first, please, Kahane, would you please make your presentation?
Thank you very much, Professor Nakaide, for this introduction, and thank you for organizing this meeting, Professor John and other colleagues here. It's really amazing, this place. I read so much about Jeju Island. I'm looking forward for the next few days to spend here. My wife came with me, so I hope we'll have a good time here. I'd like to talk about the financial consumption on a global view, and also about the producers of some of the solutions, also from a global view. I didn't prepare a slide presentation. I have a slide presentation, but I decided to talk without it. And we are trying to focus really on big issues now. Methodological issues, the question of a paradigm shift that we have to go through, and I'll try to be as short as possible. Since I'm talking slowly, I'm trying to read more or less from the text that I prepared in order to be very precise and not to spend too much time. So let's start. I'll start by stating that the industrial economy is geared toward maximization of wealth. And this target has led us to tremendous achievements, economic achievements, during the last 2 centuries, and especially during the last few decades. And just to say a few words about it, I started my career in a multinational organization that worked mainly in the Orient, and specifically I worked in Korea, and it was more than 40 years ago, 45 years ago, and Korea at that time was very underdeveloped, and right now it is so developed that it's amazing. I'm really happy to see this tremendous change that took place. We had a small contribution to that personally. I bought most of the railways of the Korean Rail, and we established big projects here, like electric facilities and the deep water port of Busan, and the shipyard and the steel mills and paper plants, and you name it. Tremendous investments in this area, and it's amazing to see what happens. So this is just an example of the growth, the economic growth that we see, and what the concept of maximization of wealth has brought. Yet at the same time that we see this tremendous economic growth, this growth has introduced other new risks, and some of them present major threats to our economies and to our society. We damage the environment in such a way that some of my colleagues claim that we are reaching within 15 years the point of no return, really. That unless we urgently do something about it, the end of humanity, really, as we know it, will come later. But so the threats are tremendous. The threats on the environment, so the threats on society, social framework. It has tremendous economic effects and demographic effects, and that affect the stability of our employment market, they affect the stability of our retirement market, etc., etc. So these are becoming very urgent and pressing issues. So the focus of the paper will be toward this. Some of the inequality of income also is creating major problems and threats. Okay, the focus of the conversation will be to show the role of the financial consumers in helping them mitigate these threats and turn them into opportunities. As an insurance expert, I think that retirement savings have a major role in trying to solve the problems, and we have the potential for that. And we hold the key to the solutions, really. So think about the insurance companies, for example. They write a check when major threats are being realized. You know, environmental risks are realized. They are the major financial bodies that have to pay the check. And therefore, mitigation of some of the environmental risks and some other risks is the key concern to the insurance industry as a whole. On the other side, the retirement funds and insurance companies, especially the life insurance companies, are managing a huge portfolio of investments, and they may have the potential to use these monies to solve some of the problems. So these monies are really our money, and they are managing it for us. It's not their own money, right? So they are managing it for us. So we have the right as consumers to express our opinion and to reflect what we like them to do with this money, and probably we would prefer to see these monies being invested in directions that will save our society and will help us flourish in the future, rather than investing in things that are currently destroying our environment and destroying our humanity. So this is really an important issue. For example, if we think that climate change is a major threat to our existence, so let's try and use that money that the retirement funds are having to try and combat the issue. And the question is, therefore, do we have the needed funds to do that? And the answer is yes. The insurance industry as a whole has the funds that can solve the issues. So this is a good point. The total portfolio of long-term investments in the world is about $80 trillion. It's a huge amount. It's larger than the global annual GDP. It's a huge amount. Most people don't realize how much $1 trillion is. If you stack $1 bill, one on top of the other, it requires about 300 meters to make you a millionaire. It requires a pile of about 300 kilometers to make you a billionaire. That's a level of low-flying satellites. And it requires 300,000 kilometers to make you a trillionaire from here to the moon, okay? So this is the order of magnitude. Most people don't realize, you know, we are not geared to think in multiples of thousands. So it's an enormous amount. So in 2005, for example, there was a very famous report, the Stern report, which reports analyzed the consequences of just climate change. And they estimated that the annual cost of climate change is somewhere between 5 to 25% of global GDP already. And they estimated also that we'll need an investment of about 2% of global GDP to mitigate the risk. 2% of global GDP at that time was about $1.5 trillion. So in comparison to the amount that we are talking about, you know, the $80 trillion that has to be reinvested, maybe $7 to $10 trillion have to be reinvested annually. So $1.5 trillion is not such an enormous figure relatively. So the only question is, how can we assure that this $1.5 trillion will be invested in that direction? At present, the investments of the pension plans and retirement funds are managed toward the goals of the current paradigm. Therefore, thereby they serve mainly and almost merely the economic goals. And in other words, the maximization of the return on the investment. Most of the investments are currently made in traded short-term financial securities that have daily market valuation because of the regulation that forces them to do it. And moreover, some of the financial instruments create by themselves much volatility and risk in the market. So the question is how to start directing our investment to a different direction that serves many goals, not only the economic goal, and also that ensures the financial stability of our system. So we have to replace these short-term economic objectives by a multi-dimensional set of goals. And there is a broad agreement already that we should strive toward a triple bottom approach. That means to emphasize the economic and societal issues and the environment. This is called the triple bottom. The recent introduction, though, in the last 5 years of those things that each of us is carrying in his pocket or her pocket, you know, these smartphones, is an amazing, created an amazing change in the world. And it adds another dimension that should not be neglected. Because these instruments enables each of us to have access, immediate access to almost the entire knowledge in the world. And at the same time, it connects all of us immediately. So in no time, if something happens at one side of the world, it affects immediately the other side of the, it's known, and sometimes if it's important, it affects the other side of the world. For example, just 5 years ago, this guy, I can't remember his name, Wazi, in Tunisia, a small merchant that a day before he committed suicide, he was completely anonymous to the world. He put himself on fire, really, and he ignited a huge fire, which is called the Arab Spring. Not really a big spring, but he created the entire movement of the Arab Spring through all the communication that we had, the Twitters and the Facebook and whatever. He became a very important guy because he created those things. So this is just an example of what one person can do now in the world. It was impossible a few years ago, before the invention of these smartphones. So we have to add to the triple bottom, we have to add another thing that I call consumer consciousness maybe, or citizenship, or ethical issues, and other things that is another dimension that should be added. So I suggest you have a four-bottom system, which is four-dimensional, that will emphasize ESEC, E for the economy, S for the society, the other E for the environment, and then another C for citizenship, or consumer consciousness, or whatever. As you know, Peter Drucker introduced the concept that you don't measure what you get, you rather get what you measure. In other words, all the measurement systems that we have are serving as a goal for management. In my childhood, I used to specialize in the rifling, in sport shooting to targets. And I know that where I aim to, I hit. And the same thing is with management. So if we replace the single economic target by a more sophisticated multi-dimensional target, we have a different dashboard in front of us that directs all our activities to a new direction. And it may lead to very different results than the current concept. So governments and businesses and consumers and organizations and individuals will be aligned toward a different dashboard. So the question is how to make this dashboard happen. Most probably some of you have seen the movie Avatar. In the Avatar movie, it's a symbolic description of what I'm talking about. Because there you had the hero that was in a two-dimensional plane and in a black and white situation. And once in a while, that person was transformed into a multi-dimensional, extremely colorful system. So this is what I'm talking about. So it's a paradigm shift. It's not a regular transformation. It's not a transition. It is transformation, not a transition. So it will gain importance because the most important part of all the financial transactions is not the technicality of how to transfer money from one place to another and how to register it. This is marginally, at zero marginal cost. The major remaining issue are the risks, the credit risks that are involved. So the entire banking system really relies on the credit risk that you have presented earlier. So I think that, again, this will serve as a key to develop the insurance company and this insurance sector to get a very important part in our economy. We still have work to do, though. We have to work on the metrics. We have to work on the inclusion of also of the American insurers into the system, and the Europeans are already committed to it and are already investing a lot in the environmental and social issues. And we have to change our education system. We have to change the education of managers. We have to change the education of engineers. We have to change the education of accountants. to change the education of designers because we have to think in completely different concepts of production and cradle to cradle, the natural state, and whatever. I don't know if you're familiar with this term, but you should. The UN General Secretary has just declared a few weeks ago that the UN is going to publish new sets of metrics already by March 2016, and many organizations, including also the organization that I've established a few years ago, which is for Benefit Corporation, are working on redefining the metrics. So we need everybody of you, that you are educators and people that are involved in the insurance industry. Please give your hand, give your minds, contribute to this global effort, and I think we shall succeed. Can we do it? The typical answer is, yes, we can. The beauty of this slogan, that I don't think that anybody of you have thought about it, the beauty of this slogan, yes, we can, that it is, what is the beauty? It is in 3 languages. Yes in English, we in French, and can, which is yes in Hebrew. So yes, we can. Thank you.
Thank you very much, Kahane. So the next presentation is from Basu, India. I am very impressed by 3 words. It's a mixture of 3 languages. Okay. Thank you. Please.
Good afternoon, and thank you very much. It's an immensely difficult task to speak after Professor Yehuda Kahane. You heard him speak. He doesn't need any of this to speak. And obviously, the lesson models need all of these aids to kind of speak. What I'm going to talk about is essentially about a little bit about the Indian financial markets, as Mr. Jung asked me to speak about. And while some of the presentations, some of the things are kind of fairly common, but I want to highlight some of the challenges that exist and essentially things that are kind of happening. The broad financial sector is no different from any other part of the world. And if you look at it, pretty much all segments of the financial sector get represented in some form or the other. However, in each of the scenarios, there are certain unique things that are happening or has happened, and certain challenges that exist within the setup, which particularly affect financial consumers and the users per se. One interesting part of the market is essentially what we treat as the non-banking financial services or non-banking financial companies, which essentially cover a very large proportion of the financial market in India. It's essentially the unorganized, the semi and the unorganized sector that comes along now. So let me kind of, and then you obviously have the stage of equity, commodity, insurance, and also pension services that both the insurance and pension markets that Professor Kahane was referring to, which are the real sources of capital for most purposes. To start with, given we talk about Indian financial markets today, and it's essentially only about a 25-year-old story that we talk about, though the country is about 70 years old right now. The reason for that is that for the first 45 odd years, till about 1990-91, it was a highly controlled economy. People at that point in time were very critical about the controlled level of economy. Now, whether it has benefited or not, we'll just come to that, but part of that controlled mindset has remained. to that extent, there is some level of significant amount of control across all markets that is remaining. I'd like to point out one interesting difference out here, particularly given the colonial and the setup from which India inherited became independent and inherited the setup. The legal and the administrative setup in India was built purely on the British lines, thanks to the 200 years of British colonization. However, for some very strange reason, the financial regulatory aspect in India is built purely on the American lines. So you actually you don't have a super regulator like the Financial Services Authority or equivalent elsewhere, but like the US, you actually have a multitude of regulators. Now this has both its advantages and disadvantages. Advantages primarily in the sense that you actually have specialized regulators. Disadvantages stemming from the fact that in many cases, many times, there's not too much of interaction and then engagement between the regulators. And therefore there are certain things that seem to fall through the cracks. And I'll highlight one particular case that happened about a year and a half, 2 years back, which has significant effect, or which did have a significant effect on the consumer side of the story. The broad regulators in the market are the banking regulator, or the Reserve Bank of India. The markets are like predominantly the equity markets, and now also the commodity market regulator, the Securities Exchange Board of India. And then interestingly, the insurance regulator, IRDA, and subsequently the pension fund regulator, the PFRDA. Now, one quick point out here is IRDA was probably, now obviously PFRDA is the latest regulator, but in recent times IRDA was kind of the most prominent regulatory setup, and not too far back, only about 99, 2000. And probably for the first time they thought about setting up a regulator who was also tasked with the responsibility of market development. And hence the title also as it stands, Insurance Regulatory Development Authority. Because it was felt that just by having a regulator would not suffice. The investors, the consumers also needed to be educated about what the markets came about or what constituted the whole insurance market in India at that point in time. And for the first time they actually tasked the regulator itself of explicitly taking over some kind of market making, not exactly market making, but market building activities in terms of development. And similarly the pension fund regulator also follows the same proposition. Now, in his introductory remarks, Professor Nakaide did mention something about the financial literacy. And in terms of financial consumers, and I think even in the morning session, plenary session that we had, there were two very nice presentations, one on non-recourse mortgage lending, another on the student behavior aspect in terms of borrowing. Financial literacy becomes an important aspect. As we now know that post the global financial crisis, about I think 16 or 17 of the states in the US have made it mandatory at the high school level to have some kind of, some level of proficiency in financial literacy to even complete their A-level equivalents. It's not a graded thing, but they have to achieve a certain level of proficiency. Financial literacy in India is obviously a huge challenge. And the challenge is very clearly divided along urban and rural India lines. Urban India is generally more financially literate, though I would tend to believe that a significant part of the so-called financial literacy in urban India, or also a significant part of the financially literate people in urban India would kind of, if Professor Rob's study were to be carried out, would show very similar results. Very low, very high level of overconfidence, but really low level of understanding. And when it comes to rural India, it is essentially, most people are financially literate. Most people, and when I say financially literate, most people really don't know what financial products are, what they could do, and what is it in it for them. And one of the biggest reasons for that has traditionally been access to financial products. For the last 5 years now, the government of India under different schemes have run extensive programs of financial inclusion. And the financial inclusion at the very basic level that the government has been trying to say is to have a bank account for every single individual, every single Indian. Forget any high-end products, forget any fancy things like that. A basic bank account. And to that extent, for the RBI has recently issued licenses to what they're calling as payment banks, which will basically be a point-of-sale bank where you can do your basic financial, basic banking, for example, deposit and withdrawals at a point of sale. The main banks could still be like 20 kilometers away, and traveling 20 kilometers every day for people in India is not going to be a joke. So having it at a point of sale could potentially look at that. The other challenge that comes in is, in one of those programs that the government ran last year, there were a huge number of new accounts that were opened. The challenge right now is not about opening new accounts. So if you simply go by the number of banks today, as compared to a year back, the number is dramatically increased. But the challenge and the question that remains is, how many of these accounts remain operable after some period of time? How many of these accounts do see some kind of transactions on a regular basis? Opening an account has traditionally been far easier than actually maintaining the account in a regular running form. And the reason why that has become very relevant is because the alternative to that has been the unorganized sector and lack of knowledge. So what in India and what in a number of other countries in various different forms we refer to as the entire unorganized money lending business. The organized sector, the financial inclusion model would want to take over that. Because in the unorganized money lending business that occurs, your interest rates could be as high as about 200% a year, if not more. In fact, the saying goes, and I'm sure the saying will be similar elsewhere, saying in India goes, that a rural villager who takes money from a village money lender spends all his or her life just repaying the interest, forget the principal. And the land or the asset that is mortgaged is never recovered. And I'm sure that experiment or that example could easily be extended to other countries as well. Now that's something that is hugely a challenge, and that's a challenge which I think the day even if we could address a significant part of that challenge of educating the consumers at that level, the benefit of financial literacy and then the benefit of the financial markets would be significantly achieved. Let me talk about a little bit, in terms of how the financial regulation, how the consumers get impacted or how the consumers come in out here. The banking sector in India comprises of broadly, and if I go back to each one of them, three broad categories. You have the public sector banks, which are traditionally the government controlled or the government owned banks. The government owns a majority shareholding. Then you have obviously the entire new generation private sector banks. The only difference is, some of you might remember, which was obviously well before even I was born, till about the 1960s, there were private sector banks in India. There were private sector banks in India. The only reason that private sector banks were closed down in India, or the government so-called nationalized, starting from 1956 all the way through about 1969, was because there was conflict of interest. The owners of the banks were also owners of other industries, and they were using their own banks to channelize the capital. And at a point in time, they would just simply walk away with the money and leave the consumers high and dry. The reason why the government stepped in to kind of nationalize the banks was essentially to protect social interest. Now, one of the important things that the banks, why this comes up, and let me just in the interest of time go on. One of the very important things that the banks actually offer in the Indian context is a social security. Now, I know some of you might find it strange to believe it, but the Constitution of India officially states India to be a socialist republic. If you read the preamble to the Constitution, the first line says, "We the people of India give to ourselves a sovereign, socialist, secular, democratic republic." Yet, in real terms, India is probably more capitalist than the most capitalist country in the world, the US. Because if you think of any society, so socialist or capitalist, the minimum guarantee that a state provides to its citizens, there could be a few, and according to, you could put it up, but as I look at it, the three probably very minimal things that the state guarantees is health, shelter, food, health. Education and all obviously are very important, but I mean, they're all in some order. But if I don't have a place to stay, if I don't have food to eat, and if I don't have health care, there's nothing really that, I mean, the rest of the system doesn't work. Unfortunately, in India, none of the three are guaranteed. As a part of our constitution, it is what is called the directive principles of state policy, which is essentially what the state will strive towards that, but it is still not a fundamental right. Yes, very recently a food security bill has been passed, but we really don't know what's happening on that. Now, that would mean that my savings today is what is available for me for consumption tomorrow. My surplus income today, or what I kind of invest today, is what is available for me for consumption tomorrow. And therefore, the banking system becomes that much more important, because vast majority of the country, vast majority of our 1.3 billion population, therefore depend on the savings through the banking system for their survival in the future. And hence the need for the banking system and then the bank and the consumers on both sides to be that much more aware of what is going on becomes important. To that extent, the government and through the RBI actually mandates the banks to be highly conservative in nature. The banking system per se defines a system to be highly conservative in nature. For example, I'll give you one example of conservatism that we follow. Banks aren't allowed to invest more than 5% of their net owned funds in equity and equity-related derivatives markets in India. 80% of the bank's funds have to be invested in bond markets. We have one of the highest levels of, in fact, this is now a point of debate between the largest bank, the chairman of the largest bank, State Bank of India and the Reserve Bank. On one hand, we follow capital adequacy norms dictated by or mandated by Basel, and actually we go over that. On the other hand, we still follow our SLR and CRR requirements. So our effective regulatory capital today is somewhere to the tune of about 40% of the deposits in the bank. Most banks actually run regulatory capitals way higher than that. Now, this has been criticized a lot, but I think from a consumer perspective, given that the social benefits scenario doesn't exist in the way it should, this has actually landed up, being useful to the consumers per se. Now, is it the most efficient one? Probably not. And that's where I think the new challenge and Governor Raghuram Rajan's real challenge, I think, is to ensure that how does he make this entire behemoth of a banking system, which has access to huge amounts of capital, far more efficient in its operations. And in a sense, at times it is viewed as quite bureaucratic and then slow moving. But, I'll just add one anecdote out here. I do a lot of work with the banking industry per se. So I was talking to any banker in the run-up to 2008, up to 2007, early 2008, every banker, be it an Indian banker, be it a foreign banker, would say, oh, our central bank doesn't allow us to do this, that, and all kinds of products, and we are so constrained. The same set of people a year later, in October 2008, were kind of saying, oh, thank God we didn't do any of that. And therefore we were saved and we were not impacted by this entire crisis. Not a single person said, oh no, because we were not allowed, we didn't do it. Suddenly it became good, thank God we didn't do it. But the fact that they didn't do it was because they were not allowed to do it. And primarily because of the social impact that the banking system could significantly have. The other part which complements the banking system in India is essentially what is called as the non-banking financial services, or sometimes the non-banking financial companies in the sector. These could essentially be both organized as well as unorganized sectors. And there could be specialized operations, there could be multidisciplinary, cross-specialization, cross-functional things. And all of it could be very large players. So you could have large financial institutions which are not basically banks and then still kind of operate within the NBFC's framework. Or, for example, even today, the largest mortgage lender in the country has a subsidiary which is a very big bank, but the largest mortgage lender in the country would actually come under an NBFC classification, the Housing Finance Development Corporation, and similarly a lot of others. Or they could be very small, regionally and locally run entities. This could also essentially translate into being unorganized. So in some sense, by that definition, the village moneylender is also a part of the NBFC segment. And hence regulating them becomes extremely difficult. Because not all of them are registered, organized setups. You start a small money lending business, and as long as there are no complaints per se, and as long as there's nothing illegal per se that's happening, there's really nothing to do. And therefore the system cannot necessarily control it. The system controls for the registered, recognized, the large organized sector. The unorganized sector remains largely unregulated. And that at times kind of becomes challenging. Yet, it is a highly popular source of access to finance and access to capital for the consumers. The primary reason is bureaucracy. I want a loan for some, justifiable reason. If I go to a bank, whichever bank I go to, well, if I go to a government bank, and a government-owned bank, it will take me the longest. A private bank will be slightly lesser, but it will still take me a huge amount of time given the entire bureaucracy that I have to run through. On the other hand, the unorganized sector, the NBFCs, in a sense, is anytime money. ATM in the strict sense of the word. I can knock on your door if you are in the lowest level, if you're an unorganized village moneylender at 2 o'clock in the morning, and I can walk out from your house at 2:15 with the cash in hand. Yes, at a cost, but I can actually do that. But for a large number of people for whom access to cash at that point in time becomes important, this kind of a source becomes that much more relevant and important. What this also leads to, which has become another problem in a different context, but what this also leads to is the huge demand and a huge preference for gold in India. And that's actually related to this argument. Because gold as an asset, typically, is valued, from an economic perspective, one can look at gold as an asset where possession is ownership. Any other kind, and therefore liquidity is at the highest level. I can walk into a pawn shop, I can walk into a moneylender and deposit a piece of gold ornament and walk out with money and no questions asked. Any other kind of asset, if you want to kind of do that, there are legal issues, there are ownership issues, and then proving ownership and all that is not going to happen overnight. So there are a large number of NBFCs, there are a large number of these companies which flourish in India who actually operate on basically gold as an asset class and where they borrow and lend in gold instruments. Now this is where a real challenge happens, because it is in a sense it's a perverse incentive, but it's in the interest of the firms to ensure that their clients, which are the consumers, are kind of less informed or ill-informed. Because then they can play around with that, comparative advantage that they would gain and some kind of arbitrage profit that they're making. And then the benefit or the real benefit of financial inclusion in India would be the day when the consumers at that level, even though they might still have access to or they might still be using these kinds of sources of funding or sources for capital, but actually are aware of their rights and aware of what it entails for them to get in there, vis-a-vis if they were to go to a registered society, a registered system. One attempt in that scenario that has been attempted has been obviously the introduction of microfinance and microfinance institutions in the country. Professor Mahmood is sitting out here and he obviously knows much more about this part, at least from a Bangladesh experience, than I do. But from the hugely successful experiment that Professor Yunus has done in Bangladesh, unfortunately for some strange reason, it's not been as popular in India. It's been popular in segments, but it's not been really taken off to the extent that one would have thought it would take off, given the benefits that the microfinance and microcredit essentially brings to the table. I think it's again some part of the fact that most of these microcredit institutions were kind of taken over in India and run, even today are run by somewhat for-profit entities whose primary objective is actually profit maximization. as Professor Kahane was saying, wealth maximization in a sense. It's still thought about that could be a significant game changer or a significant breakthrough if it could be made popular and successful in the markets for that kind of a population segment. The equity sector, okay, now going on to the other sectors which are also kind of important. The equity sector is kind of driven by three main stock exchanges: the BSE, Bombay Stock Exchange, the National Stock Exchange of India, and MCXSF, which is a very new stock exchange. So I'm not really going to talk much about it, but particularly the National Stock Exchange is one point I would want to highlight in the sense that how even equity market investors